Did you know that some of the most powerful, um, consistently profitable financial institutions in the world actually plan to lose money on the physical product they sell you?
Yeah, it completely breaks the standard rules of commerce. I mean, think about it.
Right, because normally if you sell a physical thing for less than it costs to make, you're toast.
Exactly. If you manufacture televisions, right, and it costs you $1,000 to make a TV, but you sell it for 900, you are out of business by Tuesday.
But in the world we're exploring today, I mean, that kind of math is just a standard Tuesday.
It really is. It's built into the
In
system.
the world we're stepping into is this invisible engine that quietly underpins, well, the entire modern global economy. We're talking about property and casualty insurance,
Yeah.
P&C.
The stuff that covers your home, your car, every small business on your street.
Exactly. So today, we're doing a massive deep dive to demystify this entire industry. We're looking at a stack of research, but we're primarily using Raunak Ghosh's extraordinarily comprehensive guide, The Business of Risk.
It's a fantastic resource.
It really is. And our mission today is incredibly specific. By the time we finish this conversation, you, our listener, will be equipped to read any insurance carrier's financials.
You'll understand all their bizarre jargon, too.
Yes, and you'll know exactly how they make their money. We want you to understand every single calculation to a T.
To get there, though, we really need to strip away the corporate logos and,
Yeah.
the catchy television mascots.
Right, the geckos and the emus.
Yeah, exactly. We have to look at the fundamental product. What are you actually buying? Because you aren't buying a physical good.
You're buying a concept, really.
You are buying what Ghosh calls the promise. As a policyholder, you agree to pay a relatively small, highly certain amount of money today.
Right?
And in exchange, the carrier makes a promise to pay a massive, highly uncertain amount of money at some unknown point in the future.
But only if a very specific covered peril happens, right?
Correct. A peril being a destructive event, like a windstorm, a house fire, or a fender bender.
So it's a small certain amount now for a large uncertain amount later. I love that framing. But, I mean, just looking at it logically, one single house burning down to the ground is a complete financial catastrophe for that family.
Oh, absolutely. Hundreds of thousands of dollars. Gone.
So how does an insurance company absorb that without going bankrupt themselves? I mean, how does the math actually work?
It works through the mathematical magic of the risk pool. The carrier acts as like a central aggregator.
Okay, let's walk through the raw mechanics of that pool. And let's use Ghosh's fictional carrier from the text, Meridian Mutual.
Perfect. So imagine Meridian gathers 10,000 homeowners into this pool.
10,000 people. Got it.
And every single one of them pays $1,200 a year for their policy.
So if we aggregate that, 10,000 times 1,200, the pool has collected $12 million in cash.
Exactly. 12 million in the bank. Now, in an average year, the vast majority of those 10,000 people will never even call the company.
Right. I've had home insurance for years and never filed a claim.
Exactly. But let's say 90 of those homes do suffer a serious catastrophe, a fire, a storm, whatever. And the average cost to rebuild or repair those 90 homes is, let's say, $80,000 each.
Okay, so let me do the math. 90 unlucky homes multiplied by $80,000. The total cost of claims hitting the pool is $7.2 million.
Right. So they collected 12 million and they paid out 7.2 million.
Leaving 4.8 million left over.
Exactly.
Right off the bat, that sounds like a phenomenal business. But okay, let's unpack this. Because keeping that 4.8 million gap from shrinking to zero isn't just a matter of, sitting back and watching the money roll in.
Not at all. It takes an incredible amount of active management.
Yeah, the book notes that running this pool requires the company to master 4 incredibly difficult, distinct jobs. First, they have to select and price the risk, meaning who even gets to be in this pool and is $1,200 the right price.
Right, that's step one.
Second, they've had to collect the premium and actually earn it over time. Third, they have to pay out the claims while simultaneously holding money in reserve for the ones they don't know about yet.
Which is incredibly tricky.
And fourth, they have to stay solvent, meaning they have to ensure the whole company survives a worst-case scenario.
And, measuring how well a carrier performs those 4 jobs is just a nightmare for outside analysts. It feels like the ground is constantly shifting underneath the numbers.
Why is that? Why is insurance accounting so notoriously difficult?
Well, the primary reason is that every single claim operates on three completely different clocks at the exact same time.
3 different clocks. This is a concept that I think trips up even seasoned finance professionals when they transition into this industry.
Oh, without question, it's completely counterintuitive. The first clock is the policy clock. This dictates the legal boundaries of the coverage.
So, like, if you buy a 12-month auto policy on January 1st,
Yeah.
the policy clock ticks until December 31st.
Exactly. The second clock is the accident clock. This is grounded in the physical, real world. It marks the exact moment the bad thing actually happened.
Okay, give me an example.
Say a pipe bursts in your walls on March 15th. March 15th is your accident date. That's the accident clock.
But I mean, I might be on vacation. I might not come home and discover that water damage until April.
Right.
And maybe the insurance company sends an adjuster out, we argue over the estimate, and they don't actually write me a check to fix the drywall until May.
Which brings us perfectly to the third clock, the accounting clock. This governs when the financial transaction actually hits the company's ledger.
Okay, so let's track the clocks in that scenario.
Yeah.
The accident period is March. The policy period is the current calendar year. But the accounting period for the cash leaving the building is May.
Precisely. And if an executive mixes those clocks up, like if they compare May's accounting payments against March's policy revenue, they are going to produce a dashboard that is incredibly confident and completely wrong.
Wow. So to avoid that trap, to truly understand how these clocks interact, we have to start at the very beginning of the customer journey. Let's talk about the front door of the business.
Pricing, exposure, and getting the money in.
Yes, and this is the part that genuinely blows my mind. We talked about manufacturing a television earlier. If a tech company builds a TV, they know to the penny what the glass screen, the microchips, and the plastic casing cost before they set the retail price.
They have perfect information on their costs.
Right. But an insurance carrier is setting a price today for a car crash that might happen 11 months from now and then might take 3 years to settle in court. How do they price a product when they don't know the cost of goods sold?
It is the ultimate exercise in pricing the unknown. Actuaries approach this by building up an expected cost using two foundational building blocks:
What are they?
frequency and severity. Frequency measures how often a specific type of claim happens. Severity measures how much that claim costs, on average, when it does happen.
Okay, let's do the math on this so we understand it to a T. If we are pricing auto insurance, and historical data tells us that out of every 10 drivers, one of them will cause a crash this year. That is our frequency, right?
Yes. 1 out of 10 is a 10% frequency, or 0.10.
And when that one driver crashes, the average cost to fix the bumper and pay the medical bills,
Yeah.
the severity is, let's say, $5,000.
Exactly. So to find what we call the pure premium, or the loss cost, you multiply frequency by severity.
Okay, 0.10 multiplied by $5,000 gives you $500.
Correct. That $500 is your pure premium.
Meaning mathematically, the core expected cost of the risk for that single driver is exactly $500.
But you cannot charge the driver just $500.
Because then you just break even on the claims.
Exactly. If you only collect enough to pay the claims, you have nothing left to pay your employees, keep the lights on in the building, or, pay taxes. You have to load expenses and a target profit margin onto that pure premium. So if it costs you $200 to run the business and secure a tiny profit, your final charge premium becomes $700.
$500 for the claims, $200 for the business, $700 total. That makes sense in a vacuum. But the real world isn't static, right?
No, it's constantly shifting.
I mean, inflation makes car parts more expensive, medical costs skyrocket, climate change makes storms more destructive. How do the actuaries actually know if their current price is keeping up with reality?
To figure that out, they calculate a metric called the rate indication. A rate indication is essentially a mathematical proof of whether the prices currently in the market are adequate to cover tomorrow's reality.
How do they do that?
They start by figuring out their permissible loss ratio.
Okay, think of this like slicing a pie, right? The whole pie is the dollar you collect from the customer.
A perfect analogy. If the company knows that 28 cents of every dollar absolutely has to go to paying agent commissions and office salaries,
Okay, that's 28 cents gone.
and they want to keep 5 cents as their profit margin.
So that's 33 cents total spoken for.
Exactly. That means they only have 67 cents left over to actually pay for claims. That 67% is their permissible loss ratio. It is the absolute ceiling of what they can afford to lose on claims and still hit their goals.
But then they look at their historical data adjusting for current trends and inflation, and they realize they're actually spending 75 cents of every dollar on claims.
Right. So their actual loss ratio is roughly 75%.
Which means they're bleeding money. Their ceiling was 67, but they're hitting 75.
Precisely. And to fix it, they do a specific calculation. They divide their actual loss ratio, that 75%, by their permissible 67%.
Okay, let me follow that. 75.2, let's say, divided by 67, minus 1. That math dictates they need to raise their overall rates by roughly 12.2%.
Exactly. That plus 12.2% is their indicated rate change.
However, they can't just blindly send out bills that are 12% higher. I mean, if they do, the customers will just shop around and go to a competitor.
Which highlights the eternal tension in this business. The final price a customer sees is always a battlefield negotiation between what the actuarial math demands for survival and what the competitive sales market will actually tolerate.
Yeah. And even after that massive negotiation happens at the corporate level, that base price is not what you or I see on our auto insurance bill.
No, not at all.
I like to use an analogy here. I think of pricing an individual insurance policy like ordering a custom pizza. The base rate that the actuaries come up with is just the plain, boring cheese pizza. It's the starting line for an average person.
Right.
But then the underwriter starts adding or subtracting toppings based on your specific life.
That plain cheese pizza is the base rate. The toppings are the risk factors, and the mechanism that puts it all together is the rating algorithm. It is a highly regulated, rigid sequence of multipliers.
Okay, let's walk through the algorithm step by step.
Let's start with a $500 base rate. The very first topping you add is the territory relativity factor. Where you live radically alters your risk profile. If you live in a dense metropolitan area with terrible traffic and high theft rates, your territory factor might be a 1.20.
So the algorithm multiplies my $500 base by 1.20, bumping my price to $600.
Correct.
So I'm paying a 20% penalty just for my zip code. What's the next topping?
The tier. Insurers categorize risks into broad quality bands: preferred, standard, and non-standard. If your credit is poor or you have a spotty payment history, you get pushed into the non-standard tier.
And what does that do to the math?
That might carry a factor of 1.30i. And finally, there is the experience modification, or your mod. This is intensely personal. It looks at your specific claims history.
So if I've been a great driver,
If you haven't had a ticket or an accident in 10 years, you might earn a massive discount factor of 0.80.
so the algorithm multiplies the base rate by the territory, by the tier, by the experience modifier, until it spits out a final dollar amount.
It creates a customized, granular price for every single individual.
Which finally brings us to the moment the customer hands over their credit card. The money hits the bank account. But here is where we encounter what Ghosh's text points out as the single biggest trap in insurance finance.
Yes. What's fascinating here is that this is the absolute confusion between the cash a customer hands over and the revenue the company is legally allowed to claim.
It's the mistake almost every new analyst makes.
Completely. We are talking of the difference between written premium and earned premium.
Okay, define this for us.
Written premium is purely a sales metric. It is the total dollar amount of the contract on the day it is signed. But you have to remember what an insurance carrier is actually selling. They are selling time.
Time.
Right. On day one of a new policy, the carrier has held your risk for exactly 0 days. They have collected your money, but they haven't delivered the product yet.
So what is earned premium?
Earned premium is the true revenue. It is the fraction of the money that the carrier has legitimately earned because they actually carried your risk for a specific stretch of time.
Okay, let's ground this in a real mathematical scenario so we have it down.
Yeah.
If I buy a $1,200 annual auto policy from Meridian Mutual on January 1st, I pay them $1,200. Their written premium on January 1st is $1,200.
Yes. But their earned premium on January 1st is zero.
Zero. Where does the money go then?
The entire $1,200 goes straight into a giant liability account on their balance sheet called the Unearned Premium Reserve, or UPR.
Why is it a liability? They have the cash.
It is classified as a liability because if you get angry and cancel the policy on January 2nd, the company legally owes you that money back. It isn't theirs yet.
Oh, wow. Okay, so let's fast forward 1 month. 30 days have passed.
To figure out how much revenue the company can finally recognize, you take that $1,200 written premium and you multiply it by the 30 days that have elapsed, divided by the 365 days in the policy term.
Let me do that. 1,200 times 30 divided by 365. That gives you roughly $100.
Exactly. At the end of January, the company has officially recognized $100 of earned premium. The liability bucket, the unearned premium reserve, shrinks down to $1,100.
So the earning process happens slowly, silently, methodically, every single day at midnight.
Drip by drip.
The implication of this is massive. If a company runs a huge marketing campaign and has a blowout sales month in December, their written premium is going to look incredibly high. They're going to look flush with cash.
But their earned premium for December will barely register a blip.
Right. And if an analyst tries to judge the company's December profitability by comparing the claims that happened in December against that giant mountain of written premium,
They will conclude the company is a gold mine. But it is a total illusion. You must always match the losses to the earned premium, because earned premium is the only money tied to the risk that was actually exposed to the world.
taking their money, classifying it, earning it drip by drip. I mean, it requires a lot of math, but honestly, it's the peaceful part of the business.
Very true.
The real test of the promise and the real threat to all those careful actuarial models is when the customer actually needs that money back.
Yeah, that changes everything.
This brings us to the exit door of the business. The claims department, the friction of fraud, and following the money as it bleeds out.
The claims phase is where a theoretical abstract risk suddenly becomes a highly emotional physical crisis for a family. And it becomes a very real, fast-moving liability for the carrier.
So how does the whole cascade start?
It starts with an acronym,
Oh.
FNOL, First Notice of Loss.
The phone call.
The exact moment the policyholder contacts the company to say, my house is on fire, or I rear-ended a minivan, the FNOL is the genesis of the claim file. But from an analytical standpoint, we look very closely at the FNOL lag.
Explain the lag to us.
It is the duration between the accident clock and the accounting clock.
Good.
If you get into a fender bender on a Friday night, the adrenaline is pumping, you exchange information, but you might just want to go home. You don't call your insurance agent until Monday morning.
So that is a 3-day lag.
Right. And if you extrapolate that behavior across millions of policies, actuaries can calculate a predictable reporting delay.
Why do they need to know that?
Because it tells them exactly how much money they need to hold back for accidents that have absolutely already occurred out in the physical world, but just haven't been reported to the call center yet.
And once that call does happen, tracking the cost of that single claim is rarely straightforward.
Yeah.
I mean, if you drop a tree on your neighbor's roof, it might take a week just to get an arborist out there, a month to get a contractor quote.
And if the neighbor sues you for emotional distress, it might take 3 years to get a verdict in a courtroom.
Exactly. So how does the insurance company track the financial weight of that claim over a 3-year period?
They track it using 4 vital numbers. And if you isolate just one of these numbers, you will deceive yourself.
Let's go through them. Number 1.
The first number is the paid loss. This is exactly what it sounds like. It is the hard cash that has physically left the bank account. A check cleared to a roofing company.
Okay, that's simple enough.
Paid loss is the most certain, concrete number on the board, but it is often the slowest to mature.
Because lawsuits take forever. So what's the second number holding the place in the meantime?
The case reserve. This is the claims adjuster's professional estimate of what is still owed on a known open file. It is a highly educated guess about the future of one specific incident.
Give me an example of how that moves.
Sure. If an adjuster evaluates that crushed roof and believes the total repair will be $50,000, but they haven't cut a single check yet, the case reserve is $50,000 and the paid loss is 0.
And as they start paying contractors?
The paid loss goes up and the case reserve comes down.
Got it. Then you have the third number, the ghost in the machine,
Yes, IBNR, incurred, but not reported.
IBNR.
This isn't an adjuster's guess. This is a massive statistical buffer created by the actuarial department. IBNR does 2 distinct jobs.
What's the first job?
First, it covers the pure unknown. Those accidents that happen on Friday night but won't be called in until Monday.
Okay. The lag we talked about. And the second job.
Second, and much more importantly, it covers the expected growth on claims that are already open.
Meaning adjusters are usually too optimistic.
Exactly. Human nature dictates that early estimates are often too low. Complex claims get more expensive as hidden damage is discovered or lawyers get involved. IBNR acts as a giant financial shock absorber for the entire book of business to account for that inevitable worsening.
Which brings us to the fourth number, the ultimate truth.
Incurred loss. This is the full, true expected economic cost of the claims. The formula is simply addition.
Okay, let's state the formula clearly so you listeners can lock this in.
Paid loss plus case reserves plus IBNR equals incurred loss.
So it's everything out the door plus everything we know we owe, plus the statistical buffer for the unknown.
Exactly. When a chief financial officer is looking at a dashboard to see if the company is profitable, they only look at incurred loss. If you only look at the cash that has currently been paid, you are completely blinding yourself to the mountain of legal promises you are obligated to fulfill tomorrow.
Here's where it gets really interesting, though. The check you write to the angry neighbor for his roof isn't the only cost to the company. There is an entire shadow economy operating inside the claims department.
You are referring to LAE, or loss adjustment expense.
Yes.
Paying the claim is one thing. Investigating, defending, and administering that claim costs a fortune. LAE is split into two distinct buckets.
Let's define the first bucket.
First, allocated LAE. These are costs tied directly to one specific claim file. If the neighbor sues you, the insurance company has to hire an outside defense attorney to represent you in court. That attorney's hourly bill is allocated LAE.
And the second bucket.
Second is unallocated LAE. This is the broader overhead. It pays the salaries of the entire claims adjusting staff, the rent for the call center, the software licenses to track the data. It is the cost of running the claims machine itself.
And that allocated LAE, specifically the litigation piece, is what triggers a phenomenon the book calls the severity spiral. It is terrifying for an insurance company.
It is the single biggest driver of runaway costs in modern casualty insurance. Let me give you a realistic scenario to show how fast it spirals.
Please do.
Say two cars collide. The at-fault driver's carrier reaches out to the injured party directly. They negotiate a settlement for medical bills and pain and suffering, and they close the file for $15,000.
Seems reasonable. Everyone walks away.
But what if that injured party sees a billboard for a personal injury attorney and decides to litigate instead?
Okay, so a lawyer gets involved.
The core physical injury hasn't changed, but suddenly the plaintiff's attorney demands $35,000. To fight that demand, the carrier has to spend $12,000 on their own defense attorneys, private investigators, and medical experts.
Wow.
And eventually, they settle. A claim that should have cost the pool $15,000 just cost the company $47,000.
The costs more than tripled. And it wasn't because the medical care got better, it's purely the friction and the bloat of the adversarial legal system.
Absolutely.
Which tells me that if an executive is tracking their percentage of claims that end up in litigation, they are effectively predicting their future severity spikes.
Completely. However, the exit door of the business isn't a total bloodbath. There are mechanisms where money flows back into the carrier's pockets.
Yeah, let's talk about recoveries, salvage, and subrogation.
These are the quiet profit centers of the claims world. Salvage is straightforward. If you total your car, the carrier pays you the full actual cash value of the vehicle.
Right.
But in return, they take physical ownership of the wreck, they tow it to an auction lot, and sell the twisted metal and usable parts for scrap. That's salvage.
Okay, what about subrogation? That word sounds intimidating.
Subrogation is much more aggressive. Imagine you are sitting at a red light, minding your own business, and a commercial delivery truck rear-ends you.
Ouch. Okay.
Your insurance company wants to get your car fixed immediately, so they pay your body shop bill right away. But it wasn't your fault.
Right, the truck hit me.
So your carrier legally steps into your shoes, they subrogate your rights, and they aggressively chase the delivery company's insurer to get reimbursed for the money they just laid out.
So to find the true final net cost of a claim, we have to look at all of this together.
We do. Here is the formula.
Okay, let's do the math again.
The net cost equals the paid loss plus the loss adjustment expenses minus whatever they got for salvage minus whatever they recovered in subrogation.
Got it. So if a carrier pays out $50,000 for a burned-out food truck, spends $5,000 on lawyers, but manages to recover $15,000 from the negligent stove manufacturer,
the net impact to the risk pool is only $40,000. A highly aggressive subrogation team literally lowers the company's loss ratio without the sales team having to sell a single new policy.
That's incredible. Okay, we have tracked the cash flowing into the front door, we've watched the claims, and lawyers bleeded out the exit. Now we have to zoom out to the boardroom. How does the executive team figure out if this chaotic machine is actually winning? We need to build the scorecard.
The ultimate grade in the insurance industry is the combined ratio. It is the holy grail of metrics. It is the purest measure of underwriting discipline, and it is built by fusing two smaller ratios together.
Let's build it. Part one is the loss ratio.
The loss ratio answers the most fundamental question. Did our actuaries charge enough money to cover the disasters? The math is incurred losses divided by earned premium.
Walk us through an example.
Let's say Meridian Mutual earns $100 million in premium over the course of the year. During that same year, they incur $62 million in losses and adjustment expenses.
Okay, so you divide 62 by 100 and your loss ratio is 62%.
Simple as that.
Part 2 is the expense ratio.
This measures the operational efficiency of the building. How lean is the management team? The formula is underwriting expenses, which covers everything from agent commissions to corporate marketing to executive salaries, divided by that same earned premium.
So if Meridian spends $33 million running the corporate machine,
You take 33 divided by 100, giving an expense ratio of 33%.
and the grand finale, the combined ratio, is just adding them together.
Loss ratio plus expense ratio. 62% plus 33% equals a combined ratio of 95%.
So in plain conversational English, what does a 95% combined ratio actually mean to an investor?
It means that for every $1 of premium the company legally earned, exactly 95 cents went straight out the door to pay for claims, lawyers, and business expenses.
Leaving 5 cents.
Yes, the remaining 5 cents stayed inside the building as underwriting profit. The golden rule is simple. Any combined ratio under 100% means the core operation of insuring risk made a profit.
And anything over 100% means the core business lost money.
Exactly.
But let's role play for a second. I am the CEO of Meridian Mutual. I pull up my monthly dashboard and my combined ratio isn't 95, it has spiked to 103. I am losing 3 cents on every dollar we earn. My hair is on fire. How do I fix it?
If you just stare at the number 103, you can't fix anything. A top-tier financial analyst has to decompose that variance.
Decompose it. Break it apart.
They have to rip that 103 apart to show the CEO exactly where the bleeding is coming from. Did the loss ratio spike by 4 points because a hailstorm destroyed roofs in Texas? Did the expense ratio creep up by 1 point because we overpaid for a national TV ad campaign?
Right.
Or, and this is the most insidious driver, did the overall ratio go up purely because of a mix shift?
Yes, the mix shift. This is fascinating. Explain how the CEO's dashboard can show the company getting worse, even if literally no one in the company did a single thing wrong.
It's the danger of weighted averages. Imagine Meridian sells 2 products, homeowners insurance and auto insurance.
Okay, 2 products.
The homeowners team is crushing it. They operate at a beautiful 95% combined ratio. The auto team is struggling. They operate at an unprofitable 101%.
Got it. 95 for home, 101 for auto.
Now imagine the auto sales team runs a massive promotion and sells thousands of new policies while the homeowners sales remain totally flat.
Okay, so auto is suddenly bringing in way more premium.
Right. Because the auto book is suddenly a much larger percentage of the total company revenue, the overall company ratio gets dragged heavily toward that 101% mark. The overall company ratio might jump to 99.
Wait, but neither individual team got worse.
Exactly. The home guys are still at 95. The auto guys are still at 101. The underwriting didn't deteriorate. The blend of the portfolio just shifted toward the weaker product.
Wow. So if an analyst doesn't isolate the mix shift, the CEO might fire the underwriting staff for a problem created entirely by the sales staff.
That happens all the time.
But wait, this brings up the most mind-bending reality of the insurance industry. If my combined ratio is 103, I am technically losing money on my core product.
Yes, you are.
Yet we see major insurance companies operating at 102 or 104% combined ratios for years at a time, and they don't go bankrupt. In fact, they pay dividends. How do they survive?
Because the underwriting profit is only half the story. The true engine of wealth in this industry is a concept Warren Buffett famously weaponized, the float.
The float. This is the secret sauce. Explain the mechanics of this to us.
Think back to the liabilities we discussed earlier. The unearned premium reserve, the cash customers paid up front that the carrier hasn't earned yet.
Right, the liability bucket.
And the loss reserves, the giant pools of money set aside to pay for lawsuits that might take 5 years to settle.
Okay.
Add those 2 buckets together, that is a gargantuan pile of physical cash sitting in the carrier's bank accounts. Now, legally, that money doesn't belong to the shareholders. It is spoken for. It belongs to the policyholders and the future victims. But while that cash is just sitting there waiting to be paid out, the insurance company is allowed to invest it.
They get to play the market with billions of dollars of other people's money.
And they get to keep 100% of the investment returns. This introduces the operating ratio. The operating ratio is the combined ratio minus the investment income ratio.
Let's do the math on that.
Let's say your combined ratio is 103%. You lost 3% on underwriting. But because you have $10 billion afloat invested in treasury bonds and corporate debt, you earn a 6% return on your premium base.
So 103 minus 6 gives you an operating ratio of 97%. The company still generates a massive net profit.
Exactly.
So they are essentially operating a giant investment hedge fund, and they are using a slightly unprofitable insurance business simply to acquire the cash to feed the fund.
That is exactly how many legacy carriers operate. And to tie it all back to the investors, this all rolls up into the ROE, or return on equity.
How does that math work?
The board takes the net income, which is the underwriting profit or loss, plus the investment income minus taxes, and divides it by the total equity or surplus of the company. That ROE tells the shareholders exactly how efficiently their capital is being compounded.
It's brilliant, but there is a terrifying catch to this entire scorecard.
Oh, absolutely.
The combined ratio, the operating ratio, the ROE, every single one of those metrics requires the company to know exactly how much they owe in incurred losses. But as we established when we talked about IBNRs, they don't actually know.
No, they don't.
They are guessing at the future cost of unseen disasters. If they guess wrong, the entire scorecard is a lie. Which brings us into the dark arts.
The dark arts of reserving.
Yes. How do actuaries predict the ultimate cost of claims that won't settle for a decade?
Well, if we connect this to the bigger picture, the loss reserve is the largest, most dangerous liability on an insurance carrier's balance sheet. To estimate it, actuaries rely on a visual and mathematical tool called the reserving triangle.
Preserving triangle. Paint a picture of this for me. What are we looking at?
Picture a large grid on a whiteboard. Down the vertical left side, the rows represent the accident year, the year the bad things physically happen.
Okay, so 2020, 2021, 2022 going down the side.
Exactly. Now, across the horizontal top, the columns represent the age of those claims measured in months, 12 months, 24, 36, 48 months.
Okay, I see the grid.
As you read across a single row from left to right, you are watching the paid cash grow as that specific year gets older and lawsuits slowly settle.
So the numbers just get bigger as you move right.
Right. Now, the oldest accident years, say claims from 2015, have had 10 years to mature. Their data fills out the top rows all the way across.
But what about the recent years?
The youngest year, the current year, is only 12 months old. It only has data in the very first column. Because the data tapers off at the bottom, the numbers form a literal triangle shape on the grid.
And the actuary's entire job is to figure out what numbers belong in the empty white space on the bottom right of the board. They have to predict the future of those young green years.
And the mechanism they use to fill in that blank space is called a loss development factor, or LDF. They study the mature years at the top to find predictable patterns of growth.
Okay, let's walk through an LDF calculation.
Let's look at accident year 2020. At 24 months of age, the company had paid out $10 million. When they checked back a year later at 36 months of age, the total paid had grown to $11.5 million.
So you divide the later evaluation by the earlier one.
Yes. 11.5 divided by 10 equals an LDF of 1.15.
Meaning the claims from that year grew by 15% between year 2 and year 3.
Exactly. Actuaries average these factors across decades of history. Once they believe they have a reliable pattern, they apply it to the young years to project their final ultimate resting cost.
And the book mentions 2 primary methods they use to apply these factors.
Yes. The most famous and the most intuitive is the chain ladder method.
Let's use an analogy here because actuarial math can get dense. Imagine we were trying to predict the final score of a basketball game.
That is a brilliant way to conceptualize it. The chain ladder method is pure pattern extrapolation. It assumes the early behavior flawlessly predicts the final outcome.
Okay, set up the basketball game for us.
Let's say a young accident year is like a basketball game at the end of the first quarter. The home team has scored 25 points. Historically, the actuaries know that an NBA team typically quadruples its first quarter score by the end of the game.
So the cumulative LDF is 4.0?
Correct. Under the chain ladder method, you take the 25 points currently on the board, multiply it by 4.0, and you confidently predict the final ultimate score will be 100 points.
Which means we need to hold enough reserves to pay out 100 points worth of claims. That makes total sense. But wait, what if the star player twisted his ankle in the first quarter and the team only scored 10 points?
Oh.
If I blindly use the chain ladder method, I take those 10 points, multiply by 4.0, and predict a final score of 40 points? I am going to severely under-reserve.
You have just identified the fatal flaw of the chain ladder method. It is hypersensitive to early noise.
Early notice.
If the initial data is unusually high or unusually low due to random chance, say, a mailroom delay caused a backlog of checks. Chain ladder multiplies that freak anomaly into a massive compounding error.
Ah, I see.
That is why, for very young, volatile years, actuaries pivot to a second approach, the Bornhuetter-Ferguson method, or BF.
How does the BF method smooth out that noise? Let's stick with the basketball game.
The Bornhuetter-Ferguson method refuses to trust the early noise. Instead, it blends the actual reported data with an independent expectation of what should have happened based on original pricing models.
Okay, so it's the end of the first quarter, and the team has only scored that strangely low 10 points.
But the BF method says, hold on, we know this is a championship team. Based on their historical average, we expected them to score 120 points tonight.
Okay, so we have 10 actual points and an expectation of 120. How do we blend them?
The actuaries look at the clock. The first quarter is 25% of the game. That means 75% of the game is still unplayed or undeveloped.
Okay, undeveloped. I like that.
The BF method takes the 10 points we actually scored and adds the undeveloped portion of our expectation.
Let me do that math. 75% of our expected 120 points is 90 points.
Right. Add the 10 actual points to the 90 expected points, and the BF method predicts a blended final score of 100 points.
It anchors the crazy, noisy reality to a more stable historical expectation. That prevents wild swings in the balance sheet.
Exactly. The rule of thumb is use chain ladder for old, mature years where the noise has settled. Use Bornhuetter-Ferguson for green, volatile years where the data can't be trusted yet.
But I have to push back here. Actuaries are incredibly smart, but they are playing with statistical fire.
Yeah.
They aren't psychics.
No, they definitely aren't.
What happens when the patterns break? What happens if the reserves they set in stone 3 years ago turn out to be wildly, catastrophically too low today?
When that happens, you trigger the scariest phrase in an insurance boardroom: prior year adverse development.
Prior year adverse development.
Yeah.
That sounds bad.
It's a nightmare. If claims from 2022 start blowing up in court in 2025 and the reserves run dry, the company has to find the cash somewhere.
Where do they get it?
They are forced to take money out of today's premium revenue to pay for yesterday's mistakes.
Meaning a bad guess made by an actuary 3 years ago destroys my profit margins today.
It obliterates current earnings, and this reveals why under-reserving is a deadly, seductive trap.
Seductive? How?
If an executive aggressively lowers reserves today, the company looks wildly profitable on paper. Earnings per share go up. Executive bonuses trigger.
Wall Street cheers.
But it is an illusion. They are simply hiding tomorrow's ruin. When the lawsuits finally settle 5 years later, the truth comes out, the adverse development hits, and the company collapses.
Wow. Okay, so massive reserving protects us from normal, everyday claims that just take too long to settle. But what happens when the universe throws a curveball?
You mean catastrophes.
Exactly. Reserving triangles rely on historical patterns. But what if a Category 5 hurricane stalls over Miami tomorrow? There is no historical pattern for a $100 billion loss on a Tuesday.
That is the ultimate fear.
This brings us to the existential layer, surviving the worst day, reinsurance, and capital management.
To survive a true catastrophe, a primary insurance company must realize it cannot hold all the risk it writes. It has to share the burden. It has to buy insurance for itself.
Oh, they buy their own insurance policy.
Yes. This is the reinsurance market. You pay a portion of your premium to a massive, often global entity like Swiss Re or Munich Re, and they agree to take a massive chunk of your risk off your balance sheet.
The book says this creates 3 important perspectives of risk: gross, ceded, and net.
Right. Gross is the total, terrifying amount of risk the primary company originally wrote. Ceded is the portion they successfully handed off to the reinsurer. Net is what remains.
So net is the risk the primary company actually holds and must pay out of its own pocket.
Exactly.
How do they actually execute that handoff? Do they just split every bill down the middle?
That is one common structure known as a quota share treaty. It is a strictly proportional split.
Give me an example of quota share.
If Meridian Mutual negotiates a 40% quota share, they hand over 40% of their premium to the reinsurer. In exchange, the reinsurer pays 40% of every single claim that comes in. From a scratched bumper to a house burning down, it provides steady, predictable relief.
But a quota share doesn't really save me from a doomsday scenario, right? Think back to Hurricane Andrew in the 90s, which bankrupted dozens of carriers.
Right, because of the sheer scale.
If a hurricane causes $1 billion in damage and I have a 40% quota share, the reinsurer pays $400 million. But I still have to come up with $600 million. That
Yes.
might still bankrupt me.
Which is exactly why carriers purchase a second type of protection, excess of loss or XOL.
Excess of loss, how does that work?
This is non-proportional. It acts essentially as a gigantic corporate deductible designed exclusively for catastrophic events. The primary carrier agrees to cap all the small, everyday losses, but the reinsurer steps in to absorb the catastrophic spike.
Let's run a disaster scenario so we can see the math.
Imagine a massive coastal hurricane causes $55 million in total gross losses for Meridian. Fortunately, Meridian purchased an XOL treaty. The treaty states that Meridian has a $10 million retention, which is their deductible.
Okay, $10 million retention.
Above that retention, the reinsurer provides a $50 million limit of protection.
Okay, let's step through this. The storm costs $55 million. Meridian pays the first $10 million, hitting their retention.
Correct.
That leaves $45 million of destruction left over.
And because that $45 million is safely underneath the reinsurer's $50 million limit, the reinsurer writes a check for the entire $45 million.
So the gross loss to the system was $55 million. But Meridian's net loss is capped at their $10 million retention. They survive the storm.
They do. The only secondary consequence is that they will likely have to pay a steep reinstatement premium to the reinsurer to buy back that $50 million limit for the rest of the hurricane season.
But how does an executive team even know how big of an XOL limit they need to buy? How do they know a storm will cost $55 million and not $500 million?
They rely on catastrophe modelers who look at two critical metrics, TIV and PML.
Let's define TIV first.
TIV is total insured value. This is the sum of every single property value exposed in a specific geographic area.
So every house, every business they cover in that zip code.
Yes. And mapping TIV reveals the danger of accumulation. You might have thousands of highly profitable, perfectly priced home policies, but if they're all clustered in 3 zip codes on the Florida coast,
Those thousands of independent risks suddenly merge into one terrifying, highly correlated risk when the wind starts blowing.
right, they all catch on fire or blow away on the exact same afternoon.
To quantify that fear, risk officers model the PML, right? Probable maximum loss.
Yes. It is a sophisticated simulation of the largest financial hit the carrier would face from a severe 1 in 100-year or 1 in 250-year disaster.
So what happens if they get that wrong?
If a company's modeled PML ever grows larger than the reinsurance limits they purchased, they are flying completely blind into a potential insolvency crisis.
So what does this all mean? If the reinsurer disputes the bill, or if the reserving triangles fail, how does the state regulator know the company won't just fold?
They look at the bedrock of the company, policyholder surplus. This is capital insolvency.
Policyholder surplus. What is the math on that?
Surplus is simply the company's total admitted assets minus their total liabilities. It is the raw cash cushion held in reserve for a rainy day.
And the book mentions an ultimate health check here.
Yes, the premium to surplus ratio. It measures the carrier's operating leverage.
Give me the math on the leverage.
Let's say Meridian writes $800 million in net premium over a year, and they hold $400 million in surplus capital.
You divide 800 by 400, giving you a ratio of 2.0.
Exactly. This means for every $1 of safety cushion, they are taking on $2 of risk. Regulators generally consider a 2.0 ratio to be healthy and stable.
But imagine the CEO demands aggressive growth. The sales team slashes prices and balloons the premium to $1.2 billion.
And because they slashed prices, profits fall, and the surplus remains completely flat at $400 million.
Only do that math. 1.2 billion divided by 400 million, the ratio spikes to 3.0.
The company is now highly leveraged. The exact same $400 million cushion is now supporting a radically larger universe of risk.
And if a bad year hits?
Like a mild recession, an uptick in auto severity, a few bad hailstorms, that $400 million will be consumed much, much faster. Rapid top-line growth resting on flat capital is the silent killer of insurance companies.
Okay, we have built a massive theoretical architecture here. We have pricing algorithms, reserving triangles, reinsurance treaties, and leverage ratios.
It's a lot of moving parts.
It is. But none of this matters if the underlying data is garbage. How do we know the numbers on the CEO's dashboard are actually real?
That is the million-dollar question.
This takes us to the grueling, unglamorous discipline of keeping the machine honest. The data pipelines and the month-end close.
The unsung heroes of the insurance industry are the accounting and data teams who execute the month-end close. And their guiding philosophy can be boiled down to 4 words: balance first, analyze second.
Balance first, analyze second. Meaning, you don't get to look at the fun profitability metrics until you prove you didn't lose any data.
Exactly. Before a dashboard is ever published, the analysts must prove what are called roll-forward identities.
Roll-forward identities, what are those?
These are rigid mathematical proofs demonstrating that every dollar is accounted for. The most sacred identity is for premium.
Let's walk through that formula.
It states, beginning unearned premium plus the written premium that came in during the month minus the earned premium recognized during the month absolutely must equal the ending unearned premium.
It has to balance to the penny.
To the penny. Let's do a quick example. If you start the month with 58 million unearned, you write 11 million in new sales.
So that's 69 million.
And you earn 9 million.
Then the system must show exactly 60 million unearned at the end of the month.
Right. And if the general ledger says you only have 59.9 million, the identity has failed. The close halts. You do not publish the financials.
Oh, wow. So someone has to go find that money.
An analyst has to hunt through millions of rows of data to find the break. Usually it's a processing error, a dropped endorsement where a customer added a teenager to their auto policy midway through the month, or a misstated cancellation that threw off the earning algorithm.
But a modern carrier might have 3 million active policies, generating 10 million transactions a month. They aren't doing this in Excel spreadsheets. How does the data actually flow from the customer's agent to the CEO's dashboard?
This is where old-school finance meets modern data engineering. Many legacy carriers still run their core policy administration on mainframe computers built in the 1980s and 90s.
Like an IBM AS400.
Exactly. To turn that raw transaction data into a modern analytical dashboard, they build a data pipeline, typically structured in 3 layers: bronze, silver, and gold.
Walk me through the pipeline. Start at bronze.
The bronze layer is the ingestion point. It is an exact, untouched replica of the raw data pulled from that 30-year-old mainframe.
So it's probably pretty messy.
It is chaotic, it contains typos, but it is the unvarnished truth of what was entered by the agents. The pipeline then scrubs and transforms that data, moving it into the silver layer.
And what happens in silver?
Silver is where the dates are standardized, the canceled policies are filtered out, and those critical roll-forward balancing checks are executed.
And once it balances, it moves to gold.
Gold is the promised land, usually hosted in a modern cloud environment like a Databricks lakehouse. The gold layer is the certified data source. It is highly governed.
Meaning everyone uses the exact same definitions.
Yes. In the gold layer, a term like earned premium has exactly one legally approved mathematical definition.
Why is that governance so critical?
Because if you don't enforce it, the chief actuary will query the database using one definition, the chief financial officer will use another, and they will walk into a board meeting with 2 completely different numbers for the exact same metric. Gold ensures one version of the truth.
Okay, so the pipeline is clean, the data is balanced, the truth is established, the CEO pulls up the dashboard, and she sees that written premium is up 15% year over year. The sales team is popping champagne.
As they usually do.
But I want to challenge this instinct. Based on everything we've discussed about leverage and exposure, is all growth actually good?
This raises an important question. It is the most dangerous assumption an executive can make. Pure top-line growth is meaningless until you decompose the anatomy of that growth.
What do you have to look for?
You have to ask, did we grow by increasing our rate or by increasing our volume? Let's say premium is up 15%. But you dig into the gold data and realize that your overall policy count went up 19%.
Wait, if premium is up 15 but policy count is up 19, that means your average premium per policy actually dropped. Oh, that is terrifying. That means we took on 19% more physical risk. More cars driving on the road, more houses sitting in the path of storms, but we collected less money for each one of them.
Precisely. The sales team is artificially buying volume by cutting prices, likely scooping up high-risk, non-standard customers that your competitors smartly rejected.
And what happens to that 15% revenue growth?
That 15% revenue growth today will almost certainly mutate into a catastrophic loss ratio in about 12 to 18 months when those bad risks start crashing their cars.
And even if you aren't cutting prices, you can still be ruined by the mix effect we talked about earlier.
Exactly. Growing rapidly in a highly volatile, unprofitable product line while your stable, profitable lines stay flat, is a recipe for a deteriorating combined ratio. Quality of growth always supersedes velocity of growth.
Which brings us to the ultimate, quietest engine of long-term profitability in the entire industry: customer retention.
Yes, the economics of acquisition are brutal. You measure this through LTV, customer lifetime value.
Let's break down the unit economics of LTV so we understand it clearly.
Suppose an insurer spends $300 in marketing, underwriting reports, and agent commissions just to acquire one single new auto customer.
Okay, minus 300 right off the bat.
Now, let's say the built-in profit margin on that $1,200 policy is roughly 10%. So you make $120 in underwriting profit a year.
Wait, I spent $300 to get them, and I only made $120 in profit. I'm $180 in the hole on day one.
Exactly. In year one, you lose money. In year two, if they renew, you make another $120.
Okay, so that's $240 total. But I'm still $60 in the red.
It isn't until midway through year three that the carrier finally works even on the original acquisition costs.
So this mathematical reality dictates that customer churn is the enemy of survival.
It destroys value. If your average customer gets frustrated by a rate increase and leaves after 2 years, you literally lose money on every single policy you write, no matter how good your actuaries are.
So the entire game is keeping them trapped in the ecosystem. How do you do that?
You make the product sticky through cross-selling and bundling. The multi-policy discount is not a generosity, it is a retention weapon.
Give us some numbers on that.
Industry data shows that a customer who only buys an auto policy might renew 82% of the time. But a customer who bundles both their auto and their homeowner's insurance with the same carrier might renew 94% of the time.
Because they don't want the hassle of moving two policies.
Exactly. They stay longer, they cost less to service, their LTV skyrockets, and they become the foundational profit engine that funds the entire enterprise.
Wow. Okay. We have covered an immense amount of ground today. We have traced the lifeblood of this industry from the first dollar collected to the final lawsuit settled.
It's an incredible journey.
It really is. Let's pull all of this together into a final mental model for our listeners.
The best way to visualize a P&C insurance carrier is as a machine built of tightly connected adversarial layers.
Adversarial layers. I like that.
You must always compare sold the written premium against true revenue, the earned premium.
Right. And you compare the risk accepted, the exposure, against the cash out the paid losses.
Yes. You compare the known debt, the case reserves, against the terrifying unseen, the IBNR.
Yes. And at the executive level, you judge the pricing adequacy using the loss ratio, you judge the operational efficiency using the combined ratio, and you judge the ultimate survival of the firm using capital, surplus, and reinsurance.
If you can conceptually trace a single premium dollar as it flows down through those layers, and you can articulate exactly why the ratios are reacting, you have mastered the business of risk.
It brings me back to the thought we started with. Buying insurance is an invisible transaction. It feels like throwing money into a black hole. It lacks the satisfying finality of buying a television.
It does.
But what we've uncovered today is that beneath the surface of that murky transaction is a highly regulated, intensely scrutinized, deeply mathematical ecosystem.
And that entire ecosystem, every decimal point in an actuarial rate indication, every LDF calculated in a reserving triangle, every limit negotiated in an excess of loss reinsurance treaty, it all exists for one singular purpose.
To make sure the promise holds.
Exactly. So that on the absolute worst day of a family's life, the day their car is crushed or the day their small business is reduced to ashes, the math works.
The check clears.
And the capital is physically there to help them rebuild their lives.
It is the ultimate shock absorber for society.
It really is.
But I want to leave you, the listener, with a final provocative thought to mull over. We've seen how beautifully this mathematical ecosystem balances itself by looking backward.
Right, looking at history.
Actuaries build triangles and loss development factors based entirely on historical data.
Right.
They predict tomorrow by studying yesterday.
Which has worked for centuries.
But what happens when the past is no longer a reliable guide? How does the increasing unpredictability and violence of global climate change threaten this meticulously balanced machine?
That's the million-dollar question right now.
When the 1-in-100-year storms start hitting the coast every 5 years, and the severity of wildfires destroys the historical patterns, can the reserving triangles and the reinsurance treaties adapt fast enough?
Or will the fundamental promise of insurance have to be entirely rewritten for a more dangerous world?
That is the existential question that will define the next generation of risk. Thanks for taking the deep dive with us. See you next time.